Welcome back to Happy Half Hour. That's Toby Weber. I'm Nick Shermans, where we discuss markets, the softer side of finance, current events, all that good stuff. We're a little off our usual calendar. Today's May 14th. Usually we would record this a few weeks ago, but you don't care about that. So May 14th, it should publish in about a week. So if some of the stuff we're talking about is obsolete, that's why. Things move fast. Look no further than the 20-something% drawdown, and we did a double back for the month of April. Markets are actually, dare I say, positive on the year.
What do you make of that? I mean, that was one of the first questions I had for you today. What do you take from that drop that we had in early April, and then not only recovered with the pausing of the tariffs, but now we've literally gone into positive territory on the year and within shouting distance of the all-time highs?
The last podcast that we did was April 4th, I believe. And I said something then, and I still think it applies, that whoever is pulling the strings on the tariff conversation or strategy is either really smart or really stupid. And I still can't answer that question. I still don't know, but 20% drawdowns are normal if you're an equity investor. I think people got worked up because of the reason. It felt like a self-inflicted wound. It seemed like a shotgun approach when a more targeted approach would have worked better. Now we're kind of walking back some of the comments. President Trump, and I don't want to get political, but has said he's not looking at the markets. Make no mistake, he's a business person. He's very much looking at the markets. Many of his donors are looking at the markets. Many of his cabinet members have worked in markets. Markets are the best barometer and influencer out there. People want to talk about the Fed and fiscal policy and what the president does. They're all taking their cues from the markets. That's the smartest money, investors voting with their capital. And it very much matters because it's an obvious scoreboard that affects most everybody.
Yeah, and it's been interesting to see in talking to our clients and other people about how panicked, nervous, uncomfortable, anxious they were in early April. And the mantra was, hey, I want to reduce risk. I want to get out. I want to sell all my stocks. And now we've seen this, huge recovery. And now I'm starting to hear from people that, hey, maybe we should be putting more money in the market, more money at risk. And so the behavioral component of this, human nature component of this is always very interesting to me.
People tend to overreact. I say this all the time, but in a world of smartphones and AI and machine learning, sometimes we forget markets are humans interacting with other humans. Markets are never going to be completely rational because humans are not completely rational. And you see that during bouts like this, where you have a trillion-dollar market cap company that's fluctuating by 20 to 40% over a period of multiple weeks. That's not an efficient market. That's not a rational market. The US economy does not change that much. So as I reflect on what happened over the last month, and I don't think we're out of the woods yet, but a lot of it was media-induced sensational headline risk. And I've said all along, I've never seen soft data, survey data, what people are saying contradict the hard data. Employment, inflation, and corporate earnings, credit spreads, all of those things were saying completely different messages. And I think the folks that were able to filter out the noise, turn off the TV, turn off their smartphone, stick to their long-term investment strategy, that were honest about their capacity to take risk, they've had a pretty good outcome. The folks that try to jump in and out and make investment decisions based on short-term noise, you're setting yourself up to be miserable.
Yeah, and I think you've said it before that a lot of times the headline of the day, if you were to fast forward 3 or 4 months, that won't even be in the vernacular 3 or 4 months from now. And I'm not saying tariffs are going to go away, but likely they won't be nearly as prominently displayed on the evening news as they are today. And likely we'll have something else that we're worried about, concerned about. Maybe it's everybody's worried about recession or everybody's worried about inflation. So the market just kind of ebbs and flows with these different concerns. And we went through one of those in April. And to your point, we're not here saying that we're done and we're going back to all-time highs, but it's just been an interesting 20% drop and 20% recovery in the span of 5 or 6 weeks.
And a lot of investors are talking about there's a lot of uncertainty out there. Well, if you invert that, when is there not uncertainty? There's changes in the way people perceive risks, but there's never a time where the market says, hey, there's nothing to see here. It's a green light. Go ahead and shovel money in the riskiest corners of the market. So I get really annoyed when people say, oh, let's wait and see. Let's wait till the uncertainty cloud lifts. And I wrote a post a couple weeks ago and I got a little bit of flack from it. I could sense it on social media. There's few fat pitches in investing. Investing is hard. The last 10 years have been relatively easy, but when you back out, investing is very difficult and there's no certainties. The only certainty is uncertainty, and there's few fat pitches. One of the fat pitches is putting capital to work during a crisis time. So during that 20% pullback, if you allocated capital, allocated cash, or you wanted to get a little more aggressive in your investment portfolio, that was the time to do it. Yet many investors deem a ugly market as the riskiest time. It's actually the opposite. When stocks are making all-time highs and valuations are stretched and investors are aloof and they think the gains are going to keep coming, that's when markets are most risky.
Yeah, it goes back to putting money to work when it feels like the worst possible time. There's a pit in your stomach. That's often the time you're going to get a better opportunity than when people are euphoric and the market is near an all-time high. Maybe talk a little bit about, now that we've had this recovery, kind of what we've seen in the market this year. We've, Mag 7 carried the market last year, potentially 2023 as well. That we've seen a pullback there, although that's been recovered for the most part. But what are you seeing in the market? What areas are performing well and what areas are still a bit of a challenge?
Well, first with the Mag 7 stocks, a lot of the pain, the acute pain during the 20% pullback was concentrated in US large caps, what had worked, big tech, which is why, another reason why people felt worse about this pullback. Because what happens when something works for a long time, like big tech or the S&P, people performance chase. So many folks were over their skis in this corner of the market. It pulled back the worst, which is not unusual. If you go back and look at some of the drawdowns for the Mag 7 stocks, many of them have punishing drawdowns, and we saw that again in the early part of 2025. But basically, on the other end, what's worked is everything that hadn't been working. So you think about foreign stocks, you think about emerging markets, you think about real estate, you think about value. A lot of these factors and asset classes that were beaten down are starting to have their day in the sun. And I actually just wrote a post, which most people will get on the 18th or 19th, that talks about the investment universe extends beyond the S&P 500. I think the early part of 2025 has really awakened folks that it's not just the S&P and chill. Yeah, the S&P's worked, but if I'm a betting man, and I don't make forecasts, but I am confident in saying the winners of tomorrow are going to be different than the winners of yesterday. People that think investing is as simple as shoveling money in the S&P and printing money, it's going to look a lot different over the next 10 years.
Yeah, and even with the recovery, we've seen international stocks are up double digits on the year. Emerging markets are up close to double digits on the year. Gold's, even with the recent pullback in gold, still up 20% on the year. Bonds have been a decent performer. So to Nick's point, some of these areas that have been laggards or have been areas that have struggled are not only doing better this year, but also continue to do better even with the recovery in the Mag 7 stocks and the rest of the market. So that's a positive sign.
And not to toot our own horn, but I feel like our blog posting, our commentary has been pretty, I don't even want to say accurate, but we've done a decent job of distilling a lot of the narratives out there. I mean, I put together a post last week that summarized all of the headlines during the market rally in April. And it was overwhelmingly negative, like doomsday stuff. And if you could just look at these headlines and not look at what the market was doing, you would have thought the market was down by 30%. And that's often the case. What people are saying on TV is looking in the rearview mirror. Markets don't care about any of that. If they're talking about it on the news, the market has thought about it. The market is looking forward. It's looking for light at the end of the tunnel. And it often starts to bounce back when it feels darkest. And again, if you're trying to reconcile the daily news flow with what the market is doing, you're going to drive yourself crazy.
No, I think that's a great point. And we don't like to toot our own horn, but I will toot our own horn a bit from the standpoint of we build portfolios that are highly diversified, low-cost portfolios. And in a year like this year, that's been very helpful. Won't always be the case, but that's been very helpful because we've owned these other areas of the market that have performed well, while the Mag 7 and some of the technology and other areas of the market have lagged. So that's been a good thing for us this year and won't always be the case, but we like to point that out when it happens.
So one thing that I personally do in every pullback, not only looking at my personal portfolio, but also the assets in which we manage for clients, and then unpacking investor behavior. Bear markets or difficult markets are a great time to look inward and challenge yourself. Did you make an emotional decision? Did you take more risk than you set out? Did you pay attention to the wrong things? So was there any reflection? Again, not that we're out of the woods yet, but did you have any personal reflection based on this latest bout?
Yeah, I'm an overly analytical person, so I'm always reflecting and looking at where my portfolio is, where client portfolios are. And I was, quite frankly, pleased that we reduced risk at the beginning of April. You know me, I'm a glass half empty guy. You're the glass half full guy. But yeah, I think you have to look at it. And you also have to look at your own emotions and your own response. Because if you were not sleeping and freaked out and overly concerned with the drawdown, not that it was comfortable, but if you were overly concerned with it, it was a good check-in to say, maybe I've got too much risk in the portfolio. Maybe I need to lighten up a little bit in that regard so that I can weather this volatility. Because regardless of what happens this year, I would expect we're going to continue to see volatility, more volatility than we saw the last couple of years. So if you feel like, hey, that's uncomfortable or I'm not handling that well, that's a great opportunity to make adjustments to the portfolio to put you on better footing from an emotional standpoint.
Yes, and if you were deeply uncomfortable about what just happened, you're probably invested incorrectly. You're probably taking too much risk. And we always say that an up market hides a lot of warts, right? Like you don't get feedback in a bull market when your portfolio is going up, every ticker symbol out there can't miss. It's tough to know where the risk is in your portfolio. Bear markets like the one we just had are a really good opportunity to see where the risk is hiding in your portfolio. Because contrary to what most people think, many advisors, many do-it-yourself investors are very much in tune with how their portfolio is doing. I'm up 10%, I'm up 20%. Most professional advisors, most do-it-yourself investors cannot tell you how much risk that they're taking until it's too late. So this is a really good opportunity to go back to the drawing board, look at your own behaviors, look at where the risk is in your portfolio, and tighten things up, because we are blessed to live in a country where you get a do-over. We just got a 20% pullback and a 20% rally. That's free tuition to go back and tighten things up. It's not always the case. Look at Japan, 30 plus years of a flat stock market. So we're blessed to live in a country that we get a do-over, and I would encourage folks to go back and do that.
Yeah, and I think we've seen this in prior downturns. We tend to get more inbound inquiries from prospects that have now been awoken to the fact that they were taking too much risk in their portfolio with either on their own or with their advisor, because they wake up and holy cow, I'm down 15, 20, 25%. And so they start to get a better appreciation for the risk they're taking. And they start to realize maybe their advisor or maybe they weren't properly equipped to handle that or build that portfolio in the appropriate manner. So we get a lot of inbound inquiries from people saying, holy cow, I had no idea I was this aggressive. I had no idea my portfolio would go down that much when the market got difficult. So, we love having those phone calls because we focus on risk. It's intentional what we do, and we think we stack up pretty well in that regard.
Our whole investment approach is designed, given our client base, I'd say 70 to 80% are retired or about to retire. So this is not a hedge fund. So we lead with the risk management side. Our whole investment process is designed to strip emotion out of the investment process. That includes building a tight filter so we know what to pay attention to, what not to pay attention to. I think in the age of the digital investor, you have to build a tight filter. You can't read Bloomberg or read CNBC and then try to implement that in your portfolio. There's so much noise out there that you can easily be crossed up. So having a tight filter, stripping emotion out of the investment process. The other part of that is our investment framework, where it's not based on gut instinct. It's not based on what I think. It's not based on what Toby thinks. As Toby alluded to, we all have personal biases, personal baggage, personal experiences that shape the way that we view money. Toby tends to think the world's ending. He thinks I'm an optimist. I'm more of a realist. I wouldn't bet against the ingenuity of U.S. companies. So we make a good balance, but we don't want that to creep into the investment process. So everything that we do is quantitative. It's rules-based. We take our cues from the market, and the market tells us what to buy more of, what to own, or what to sell. And that approach has served us well when there's all this short-term noise coming at us. So I think a lot of what we do is designed to reduce drawdowns. And for most folks that are currently retired or about to retire, they don't want to take a 2008 like that. They don't want to go back to work. So I think a lot of what we do is playing to our audience. Again, not a hedge fund, not trying to squeeze every ounce of return. We're not performance chasing. It's a very intentional investment approach.
I actually prefer pragmatist
Pragmatist.
as opposed to pessimist, but that's probably why I don't have the hair that you have.
Well, my hair is getting rare. I had a client, and I don't know if this was an insult or what, but they're like, man, you look older. You got a lot of gray hair. And it's like, well,
Market's been
I got 3 kids. This market is beating me down. I don't sleep. So yeah, that all checks out.
Okay, I got a question for you.
Okay.
Even though this is a politics-free podcast, which proclamation, declaration from our president over the past month have you enjoyed the most? I'll give you a couple of options.
I've got one that's top of mind. So my friends and I are golfers, and Trump is a golfer. Trump loves to golf. He's actually quite good. And he's been on YouTube doing some stuff with like Grant Horvat and DeChambeau, and he's very open about his love for golf. A golf term is the yips. Like if you have the yips, that means you have this short stab in your putting stroke. It's not good. No one would ever want to have the yips or wish the yips on anybody else. During peak market sell-off, first week in April, second week in April, he basically said people were getting the yips. And of course he says it funny, the yips. So he was saying that he's going to roll back some tariffs because the market was getting yippy. Everyone was getting a bit yippy. That kind of made me laugh.
Yeah, and we don't mean to make light of the current situation, but some of the stuff that comes out really makes you scratch your head. Mine was we're going to reopen Alcatraz. I don't know if he watched Escape from Alcatraz or he watched The Rock, but came out and said he was instructing his folks that we're going to reopen Alcatraz, which I'd be surprised if that ever happens. But
love Trump or hate Trump, he says some pretty funny things. I don't know if he's intentional or what, but he just says some funny things. Question for you. When did it become cool to be a pessimist? I feel like pessimism is in.
Geez, that feels like a loaded question.
It's not specific to you. It's something that I'm going to write about, but it does seem like pessimism sells.
I think there's a connotation with pessimism that it's more sophisticated. I think the market's going to go down. I think the world's going to get more difficult. I think the economy is going to go into recession. You kind of sound smart if you're predicting that. So I don't know when it became quote unquote cool or if it ever did, but there's always been an undercurrent of the smart people are always looking for the next downturn, which maybe I fall into that. But what are your thoughts?
I go on Twitter sometimes and I follow analysts and traders and hedge fund managers, and just some of the comments. It's like people, they love a good dumpster fire. They love a good train wreck. And to your point, it does sound like when someone is spouting all the things that could go wrong, it seems like they're trying to help you, like avoid, because no one wants to get crushed. Humans hate losses more than they enjoy gains. And I think it comes off with an air of, I'm trying to help you. It's sophisticated. I said this last week in my blog. If I went on CNBC and said, markets over the next 30 years, I'd say 80% of the time they're going to go up, 20% of the time they're going to go down. And, within that 20%, it's going to get weird, maybe 5% of the time. Mm-hmm. I would never be invited back. I come off as some aloof moron, but that's probably a likely scenario. So I can't understand the perpetual doom and gloom. When you back out and you look at history, there's always stuff to worry about. There's always things that could go wrong. But markets often, like someone said this in a podcast or something, but the history of the US can be defined as a line that moves up and to the right. Whether you're talking about the market, the economy, any metric that you can track, we've made overwhelmingly positive progress. And when you look at our corporate America, from Wall Street to Silicon Valley, every other country on planet Earth wants to recreate that. Like, I know we give our companies flack, and sometimes it's for good reason, because they do things that aren't in the best interest of the communities they serve and the people they serve. But overwhelmingly, what makes our country great are the people and the innovative entrepreneurial spirit, which ties into U.S. businesses. Every other country wants to copy what we have.
Agreed. Well said. One last question for you. Since our last podcast or video podcast, Warren Buffett announced his retirement at the end of this year. He'll be stepping down from Berkshire Hathaway. I think he'll remain chairman of the board. What do you take from Warren Buffett's long and successful career? What do you take from that from a investing standpoint or a personal standpoint?
I said this to you offline. I think Warren Buffett is one of the greatest, if not the greatest investor of all time. I've quoted him dozens of times in the blog. He's created a subculture of successful investors that have copied his approach of value and margin of safety. And he's just full of so many quips of knowledge, not only about investing, but life. And he'll go down as one of the greatest Mount Rushmore investors of all time. On a personal side, and I don't want to come off aggressive in this, but
Take shots at Buffett?
No.
I'm ready for this take.
As a person that tries to be balanced, I think there's many forms of wealth. There's social wealth, there's mental wealth, there's physical wealth, there's time wealth, there's financial wealth. Warren Buffett is all in on the financial wealth piece. And to me, working until I'm 94 and putting on a suit and going into the office and reading and grinding every day sounds horrendous. And that might be his happy place. But when you get out of balance that much in one area of life, you can't tell me other areas have not suffered. So I don't envy him in that regard. Sure, on a professional basis, on a personal basis, I must feel bad for him.
Wow, I did not see that coming. From my perspective, I echo some of the same sentiments you said. I think the way that I look at it is he found his passion. He found the area of life that brings him joy and energy and challenge. And he's chosen to do that for the last 75 years, which is pretty damn remarkable. And that's obviously been one of the hallmarks of his success, is that he's been around. He can compound his wealth, compound the returns in his fund year after year after year, and he's done a phenomenal job at that. I think I read that 90% of his net worth has been accumulated after he turned 65 years old, so a normal retirement age for most. And that just shows the power of compounding, that the last 10, 15, 20 years, his wealth is compounded even more. So not a perfect individual, but his success and his lessons, I think, are worth emulating.
Well, and he's still chairman of the board, right? He's still going to be involved.
Sure.
It's just really baffling. Like at 94, I hope I can stay awake. I hope I can get around on my own. He's operating at a pretty high level. So maybe there's something into his program of eating See's candy, slamming Diet Cokes, eating McDonald's, all that stuff. So
I really got a kick out of there was some show with him on there, and they followed him around, and every morning his wife puts the money for the Egg McMuffin in his car, and then he stops and he buys the Egg McMuffin and the Diet Coke and heads into the office every day.
That sounds horrible.
Doesn't get any better than that.
All right. Well, that's coming up on 30 minutes. This is Happy Half Hour. I'm Nick Shermans. That's Toby Weber. We will see you next month. Thanks for tuning in.
Cheers.